It's Brian Preston, the money guy.
The second way that you could be ruining your financial life is faking it until you make it.
There's a lot of people do this.
Oh,
I think
see
this is, I mean, we have talked about, Bo, I've picked on you for your car purchase
Yep,
when you were
I did
first
this
out.
when I was early on.
I mean, it is one of those things where I think you see a lot of people, they reward themselves with life. And look, we get it. Life is unfair because when you're young, you're full of energy, you got plenty of time, you want to go out there and do things, but you're broke as a joke.
Yep.
It's just cruel. So what happens is you hear this distant sound and you look and it's like, oh, I can just use debt that will be the bridge, and I'm sure it will be okay because I'm going to keep getting pay raises. I'll use this debt bridge to get me where I want to be. The problem is it's a siren song because what looks like a beautiful thing, you're on this bridge, but you get in debt, and you actually get this thing sitting on your shoulder. The weight gets heavier and heavier, and then you realize you're now a zombie under the control of all this debt, and you look at all the stuff that's, either out of style, it's decaying, or it's sitting in your closet or garage, and you're going to be disgusted with yourself. So do not fall in this trap of faking it until you can make it.
What I think is so funny is this doesn't just happen to people that are financially irresponsible. We actually see this happen to folks all the time who have the mindset that, you know what, I'm not going to go buy that $4 coffee. I'm not going to do this thing. I'm not going to do that thing. And they focus on all these really small decisions. And while it's true that small decisions can add up over time, if all you're doing is getting the small decisions right, but you're blowing the big decisions, like going out and buying a car you can't afford or going out and buying a house you can't afford, that is going to do way more damage than that trip to the local coffee shop at $4 a pop.
It's completely true. So let's talk about the big ones. Like you say, you don't want to major in the minors. You actually want to focus on the big things. The first one, and I say this all the time, car debt is definitely financial napalm because it's one of those things you immediately want to reward yourself as soon as you graduate college, get that first big job. You want to go buy a car, but here's why cars are horrible. First of all, they're super expensive.
Yep.
They depreciate like a rock. I'm
Immediately.
talking about as soon as you drive it off, it's worth a lot less. And then you have to pay to maintain this thing. It's not even an appreciating asset. It's something that costs you money to operate it. So yet you would think with all these things, there ought to be danger, danger, danger signs on it. People are all in this stuff constantly.
And look, if you don't believe us, we had full-time equivalent Daniel even put together an illustration of how much car can we afford or how much car should you afford. So if we assume a 3-year loan, 20% down, and the payment's not going to exceed 8% of your median household income.
Now, why do we say that? Because you gave those assumptions. Realize this is ever-expanding tent here. This is foundational knowledge.
Yep.
Why did you say 20% down, don't finance it longer than 3 years, and no more than 8% of your gross income? Why did you say that?
When it comes to buying a car, those are the metrics you have to follow. 20, 3, 8. Unless the one caveat is if you're buying a luxury brand, then you got to do it in 1 year. You got to pay it off in 1 year. 23.8 goes out the door. But if you're going to buy a car, put 20% down, finance for 3 years, or pay cash. We're not fighting you on that, but the most you can finance is to finance it for 3 years, and it can exceed 8% of your gross income. So the median household, if we know that the median household income is about $62,000 in this country, the median household can afford a car that cost a little under $18,000.
That's a nice used car.
Think
about it. That's a nice used car. That's not many
car.
new cars in today's modern world.
But the average car loan in this country right now is $34,000.
That's because there's a lot of Americans buying that new car.
That's
and look, I'm
exactly
not
right.
even against it. I buy new cars, but you can do new cars only when you can afford new cars. And as you can see from this chart, there's a lot of people that are stretching that, taking it double. Instead of buying the $17,000 to $18,000 car, they're buying the $34,000
Exactly right.
car. And also, don't fall prey to if you walk onto a car dealership and they ask you what your monthly payment or where do you want to keep your payments, here's the rest of the story. They're going to stretch your amortization. Remember, we don't want you carrying the debt longer than 3 years. Because remember, this car is depreciating. Even if you buy a good used car, it's still depreciating. 3 years keeps you protected, so you're never driving a vehicle that's underwater. It's going to be very easy for them to talk about 5 years, 6 years, 7 years on car loans, that's a disaster. Don't fall into those traps.
So cars are a very easy place that you can fake it till you make it. The second area, we've already talked about this a little bit, is credit cards, consumer debt. If you're someone who's using credit cards and you're not that person that pays it off monthly and pays it off in full every month, then you're kind of faking it. If you find yourself...
You just don't need to use credit cards.
You don't need to use it. If you find yourself accumulating credit card debt, that right there should be a huge red flag. Because frankly, and this is a little bit of cold water, if you could not pay cash for it today, you can't afford it. If you have to have the credit card to be able to buy it, I'm going to go so far as to say for consumer goods, it's not something that you can afford. And if you can't keep yourself in check, if you're not someone who can say, all right, I'm not going to let the credit card allow me to expand my lifestyle beyond what I can afford, then you can't use them. You just have to go cold turkey, and you have to be a cash or debit card purchaser.
Let's talk about the last place that people fake it or make it, the big one, which is your mortgage.
Yep.
I always end it. Look, guys, I know we're a little stricter on this, but it's because we want you to have lots of life, not be house rich, life poor. Is we want you to keep your housing, which is your mortgage, which is your property taxes, which is your insurance. If you want to be super conservative, you can include your utilities. I'm going to give you a little bit of latitude to figure that part out, but I don't want your mortgage to exceed 25% of your gross income. And look, a lot of you guys, you're going to try to figure out, I don't even want you buying a house unless you are going to be there for 5 to 7 years. I want you to think about rent the same way. I think a lot of people will actually, it's not just mortgages, it could be your rent payment. Try to keep your rent under the 25 to 30% too, because that is going to keep you in safe ground so that you can save for the future. So you're not faking your life, because that can be a problem. I mean, this is something where, look, when we all start out, have roommates, have things that can mitigate the costs so that you are left with margin so you have some flexibility in your life.
You know, another thing that I think is really interesting with mortgages is, let's suppose that you are someone, and you did exactly what we said. You kept the payment below 25% of your income, but maybe the mortgage you got was a number of years ago, and you have a rate that might be 5, 6%.
Even 4 3/4.
If you're not someone who's paying attention to where mortgage rates are and being an advocate for your army of dollar bills, then you're missing out on a huge opportunity. Because even though you might have an affordable mortgage, it might be possible for you to refinance, get a lower interest rate, keep paying the same amount of money so you're not actually stretching out the term of your loan. That's going to be more money that you can keep in your army of dollars, in your army of dollar bills, working for the long term. So if you haven't looked at or thought about a refinance in the last 2 or 3 years, either one, you've been living under a rock, or two, you've just been lazy. And if you want to stretch your dollars farther than your peers, make sure that you're staying on top of that and looking into that. If you'd like a resource, we have a resource on our website. You can go to moneyguide.com/resources. We actually have a refinance guide that will walk you through, when should I refinance, how to do the math, how to know what makes sense. It is completely free. It's available out on our website, moneyguide.com/resources.
Last thing to kind of close this one out, talking about faking it until you make it. We get this question a lot, and I think this is one of the first times we've answered it. Where in the financial order of operations does rental property come in? Because there is a lot of content creators that focus on rental property. And look, I'm going to let you answer, but I want to set the stage a little bit, Bo, because doing taxes for close to 2 decades, I dealt with a lot of real estate investors, and real estate is spectacular for one primary reason. You're leveraging returns, meaning that you're only putting down a small down payment, but you're getting the appreciating asset. You're getting, even if the asset's only appreciating at 3 or 4% a year, because you only put down 5%, 10%, 15%. If you compare that annual appreciation to what you put in cash flow wise, it looks great on paper. Now, there's a dangerous side to leverage investing, and that's what real estate investing is that when if the economy tanks and rents dry up, it can compound on you quickly. So if you start off with one house is going so well, you go to 3 houses, then you got 6 houses. I've seen this, and then you hit a downturn like 2008, 9, or 10. I've watched somebody that you looked up to because they had 25 to 30 rental houses, and you see that this thing that had created 7 figures of paper wealth completely destroys their net worth statement. But how do you protect yourself? And look, don't mishear me. We're not trashing
No.
rental real estate and real estate investing. I'm just saying, know your time and your place to get this right.
You have to get it right in the financial order of operations. And so if you're someone, because I literally had a buddy reach out to me last week. He said, hey, what do you think about real estate investing? And I said, man, I love it. I think it's great. I think it's a wonderful opportunity.
It's a great wealth builder.
And then I said to him, frankly, you're not ready for it. You were way too early in your journey, because if you were to go leverage yourself, have the debt, and you were to get into one of those downturns, or the AC goes out, or you have to replace the roof, or you don't have a renter for a while, you're not going to be able to weather that storm. So we think that it makes sense to get a firm financial footing in place, following the financial order of operations before you start getting into rental real estate. And we think that rental properties generally start to happen around the hyperaccumulation step
exactly
of the
right.
financial order of operations.
Because here's the only thing we're trying to protect you from, is that you get in a situation like we've had where you have downturns where, look, the economy goes down, a lot of employers unload their employees, so you've got unemployment goes up. People are unable to pay their rents. So when that happens, it's all going to happen to us all at once. Yes, your financial market holdings are going to go down, but if you got a bunch of S&P 500 and a diversified portfolio, you're not having to pay property taxes, homeowners insurance, and repairs on that. So what happens is when your tenants quit making rent payments and you own all these houses, you have to start carrying it just until you can go, do all the things you needed to recoup your money. You want to make sure you have enough liquidity, enough assets that you bridge that, because yes, it will go back. It will come. It's just, instead of a V-shaped recovery, it's not uncommon for real estate sometimes to sit in a U-shaped recovery and drag the bottom. I just want to make sure you have enough margin in your financial life that you can weather that, because you know who makes the most money in downturns? There's a reason Warren Buffett is such a good value-based investor. I have some clients that are real estate, and I look at it and I go, wow, the cost basis on this rental property is spectacular. And I've got a client, he'll know who he is because he listens to this show, and he's like, yeah, I picked that one up from some people, got in over their head back in the downturn. And it's true. I mean, that thing cash flowed, I guarantee, on day one, because a lot of your money in real estate is also made on the day you purchase it. And in those downturns is the biggest financial opportunity. And that's the thing. Just make sure you're doing the financial order of operations right, and I think you'll be protected.